Last week, I received a comment. It said, and I quote, "Kinda got lost in this one. Please make a video about the basics." I want to address that comment directly, not with sympathy, with a diagnosis. You did not get lost. You were deliberately confused. There is a difference, and understanding that difference is, in fact, the topic of today's video. The financial industry, and I use that word industry with full engineering precision because it is a machine built to extract value, has spent decades constructing a language barrier between you and your own capital. Every time you hear the word yield and feel a slight panic, every time someone says NAV erosion and your eyes glaze over, the machine collects a small fee. It charges you for your confusion. 1% of assets under management every single year to a human being in a suit whose primary product is the illusion of complexity. Today, we drain the moat. I am going to take the terminology that Wall Street weaponizes against you and convert it into engineering first principles. By the end of this video, the jargon is gone. What remains is arithmetic. And arithmetic, I will remind you, does not care how you feel about it. My name is Dollar Dave. I do not tell you to like and subscribe. I tell you to pay attention, because attention, properly deployed, compounds. Let's begin.
Term number 1, capital versus money. Most people use these words interchangeably. This is a category error, a fundamental one, like calling a battery the same thing as electricity. Money is a medium of exchange. It is ephemeral. It is the thing you use to buy lattes, pay rent, cover your car insurance premium, and fund a dinner out that you will not remember in a decade. Money flows through your hands. Its entire design purpose is to be spent. The moment you spend it, it is gone. It leaves no residue in your balance sheet. It generates nothing downstream. Capital is different. Capital is stored human energy. Think about that. When you went to work on Tuesday, you traded something irreplaceable, a specific block of hours from your one and only life, for a number that was deposited into your checking account. That number represents compressed human time. It is your energy rendered in numerical form. The question is, what happens to that energy next? In most American households, that energy is immediately converted back into consumption. It becomes a car payment. It becomes a streaming subscription. It becomes a furniture upgrade. And the moment that conversion happens, the energy is dissipated, gone. The person who built it gets nothing ongoing in return. Let me give you a concrete system to analyze. I want you to imagine a guy. Let's call him Standard American Male. He earns $100,000 per year. That is a solid income, top 30% of the country. He lives in a suburb. He drives a new F-150, which is currently the best-selling vehicle in America, and I want you to sit with that statistic for a moment. The best-selling vehicle in America, a truck with a monthly payment of approximately $800. Here is his annual capital architecture. $100,000 gross income. After federal and state taxes, he is taking home approximately $72,000. His mortgage is $24,000 per year. His 2 vehicle payments, because his spouse also has a car, total $18,000 per year. His food, utilities, insurance, subscriptions, clothing, and miscellaneous consumption costs run approximately $22,000 per year. His capital deployment at the end of 12 months? $8,000. Maybe. This is a system running at 92% waste. He is processing 100 units of input and converting 8 units into stored capital. The rest is thermal exhaust. It is entropy. And here's the critical fact. He has no idea what his conversion rate is. He has never calculated it. He experiences money as a flow. It comes in, it goes out, and he tracks the difference with a vague, anxious feeling that things seem okay. Now contrast him with a different operator. This individual earns $60,000 per year. That is below the median household income when you account for both earners. But this individual has a calculated conversion rate. She deploys $15,000 per year into income-generating capital every single year. That is a 25% conversion rate on gross income. Her capital compounds. His capital does not exist. At the end of 20 years, adjusting for reasonable market returns, the $100,000 earner with the 8% conversion rate has a portfolio of approximately $230,000. The $60,000 earner with the 25% conversion rate has a portfolio of approximately $1,100,000. The F-150 cost him nearly $1 million. He just couldn't see it on the sticker.
Term number 2, yield, also called dividends, distributions, or income, depending on the vehicle. Most retail investors misunderstand yield so completely that they functionally cannot use the concept.
Let me correct this. When you buy a share in a profitable company or a profitable fund, you are buying a fractional ownership stake in a cash-generating machine. That machine operates. It takes inputs, labor, raw materials, capital, customers, and it produces outputs, which are goods and services sold at a margin. The excess of revenue over costs is profit. Some of that profit is retained to fund future growth. The rest is returned to the owners of the machine. This return to owners is called a dividend. It is not a gist. It is not generosity from a CEO who woke up in a good mood. It is the API response of a profitable system. You called the endpoint returned data, the data is cash. Let me give you the exact arithmetic because this is where most people get fuzzy. You deploy $10,000 into a position. The position has a dividend yield of 5%. This means the machine returns $500 per year to you in the form of cash deposited into your brokerage account, typically on a quarterly or monthly basis. Your yield is 5%. The math is fifth-grade arithmetic. 10,000 times 0.05 equals 500. That is your deployable cash output. It requires zero additional labor from you. Your only input was the initial capital deployment. Now, let me explain why this is categorically different from price appreciation. Price appreciation is when a stock goes from $10 per share to $12 per share. The scoreboard changed. You are, on paper, wealthier. But you have not received any deployable cash. You cannot pay your electric bill with unrealized gains. You cannot reinvest unrealized gains without selling the position, which is a taxable event that triggers ordinary income tax or capital gains tax depending on your holding period and account type. Price appreciation is a number on a screen. Yield is actual cash flow. One of these things can fund your life, one cannot. I will let you determine which is which. Now, there is an important tax distinction that the American middle class systematically ignores, usually because no one told them about it. Qualified dividends, which are dividends from domestic corporations held for more than 60 days, are taxed at the long-term capital gains rate. For most American households, that rate is 15%. Ordinary income, meaning your W-2 salary, is taxed at rates up to 37% federally, plus your state rate. This means that $1 of dividend income arriving in a taxable brokerage account can be taxed at half the rate of $1 earned at your job. And in a Roth IRA, a qualified dividend inside a Roth IRA is never taxed. You deploy capital inside that account, the machine pays you its API response in the form of dividends, you reinvest, and the entire compounding chain, decades of it, is invisible to the IRS. Zero. That is the yield architecture that the industry does not want to be this simple, because if it were this simple, you would not need them.
Term number 3, NAV, Net Asset Value. This is the term that separates investors from gamblers, and most people have never heard it. When I describe an income-generating fund,
Whether it is a bond fund, a real estate fund, a covered call fund, or any other vehicle that returns cash to shareholders, the NAV is the underlying value of the machine itself. It is not the yield. It is the physical structural integrity of the asset base. Think of it as the book value of the engine, separate from the revenue the engine generates. Here is why this matters, and I want you to listen carefully because this is where retail investors get destroyed. There exists a category of investment products that advertises extremely high yields, 15%, 20%, in some cases higher. When a retail investor sees a 15% yield, their brain computes $10,000 in, $1,500 per year out. Passive income, wealth building, solved. What that investor frequently fails to check is the NAV trend, the direction the underlying asset value is moving over time. Because here is what can happen. The fund distributes 15% annually in yield, but the NAV, the underlying value of the machine, declines 20% in the same period. You received $1,500 in cash. You also lost $2,000 in asset value. Your net position is negative $500. The machine is eating its own parts to pay you. This is called NAV erosion. It is the single most common trap in high-yield retail investing. The yield is real. The cash arrives in your account. But the asset base that generates the yield is being liquidated to fund the distribution. It is not profit. It is return of capital dressed in the costume of income. A sustainable yield is one where the machine generates the cash from actual operations, while the asset base, the NAV, holds flat or appreciates over time. Finding this combination requires checking two data points, not one: yield and NAV trend. Both. Always. Now, let me introduce you to the most beloved NAV-destroying asset in America: the new car. You deploy $35,000, or as most Americans do, you finance $35,000 at a 6 to 8% interest rate, and you receive an asset with a known NAV degradation schedule. It loses approximately 15 to 20% of its value in the first year of ownership. It loses another 10 to 15% the year after that. The NAV of this asset will approach zero in 15 years. Meanwhile, it pays no yield. It charges you insurance, maintenance, registration fees, and fuel. This is the transaction that millions of Americans perform every 3 to 5 years, often rolling the remaining negative equity from the previous vehicle into the new loan. It is NAV erosion with a monthly payment attached. And the color choices are very pretty. Now we decode the instruments. Term 4. REITs, Real Estate Investment Trusts. The American cultural narrative around real estate has infected a generation of potential investors with a fantasy. The fantasy is landlord status. The image is you, the property owner, building wealth through appreciating assets and passive rental income while your tenants fund your retirement. The practical reality of the small landlord in America is this: a financed duplex, a property manager you can't quite afford, a tenant who hasn't paid in 2 months, and a toilet that failed at 2 in the morning on a Sunday. Strip away the status symbol. What is real estate investing at its core? It is deploying capital into physical infrastructure that generates rent income over time while the underlying asset appreciates. That is the mechanism. The question is, do you need to personally own the building to access that mechanism? No, you do not. A REIT, Real Estate Investment Trust, is a corporation that owns income-producing real estate at institutional scale. We are talking about portfolios of thousands of commercial properties, apartment complexes, warehouses, data centers, hospitals, cell towers. The REIT is required by law to distribute at least 90% of its taxable income to shareholders annually. You buy a share of the REIT through your brokerage account. the same account where you own S&P 500 index funds, and you receive your proportional distribution of the rental income. You do not fix a toilet. You do not answer a tenant's call. You do not negotiate with a property management company. You do not file for eviction in county court. You look at a spreadsheet, once a quarter, optionally. The trade-off is control. You do not own the building. You do not decide which tenants are selected. You do not determine capital expenditures. The institutional operator makes those decisions. In exchange, you access a diversified, professionally managed real estate portfolio from a position of approximately $5 per share entry, depending on the instrument. For a household building Architecture 0, which is what I call the initial income-generating portfolio, REITs are one of the most efficient ways to deploy small capital amounts into real asset income streams without taking on leverage or liability. Now, covered call ETFs. These include instruments like XYLD, which is the S&P 500 covered call ETF, and QYLD, which executes the same strategy on the NASDAQ 100. I want to explain this clearly because the mechanics are counterintuitive the first time you hear them. A covered call is a financial contract. Here is the everyday analogy. You own a house. Your house is currently worth $400,000. A neighbor comes to you and says, "I want the right to buy your house for $420,000 at any point in the next 30 days. I will pay you $2,000 today for that right, regardless of whether I exercise it or not." You accept. You receive $2,000 immediately. If the house appreciates above $420,000, the neighbor exercises the option and buys it. If it does not, the option expires. You keep the $2,000 and you write a new contract next month. You have converted uncertainty, whether the house will go up in value, into a certain monthly cash payment. XYLD and similar covered call ETFs execute this strategy at industrial scale on equity portfolios. The fund owns the underlying index. It systematically sells call options on that index each month, collecting premiums. Those premiums are distributed to shareholders as monthly income. The yield on these instruments is frequently in the 8 to 12% annual range, paid monthly. The trade-off, and I will not hide it, in exchange for the premium income, you cap your participation in strong upside months. If the S&P 500 rips 15% in a single month, as it occasionally does, you do not capture all of that return. The option buyer captures the upside above the strike price. You captured the premium. Whether this trade-off is rational for your architecture depends entirely on what you are optimizing for. If you are optimizing for current cash flow, for income you can reinvest or deploy, a covered call structure may be appropriate as a component of a diversified income system. If you are optimizing for maximum long-term price appreciation, it is not. This is not a moral judgment. It is a configuration decision. Know your objective function before you select your instruments.
You now have the vocabulary. Let me tell you what to do with it. Capital is stored human energy. Do not convert it entirely into consumption. Yield is the API response of a profitable machine. NAV is the machine's structural integrity. Check both. REITs give you institutional real estate income without the liability. Covered call ETFs convert market volatility into monthly cash flow in exchange for capped upside. The call to action today is not to open a trading account and immediately deploy $10,000 you do not have. The call to action is to begin what I call Architecture 0. This is the minimum viable capital system. It requires exactly one thing from you, starting immediately. $7 per day. That is the price of a fast food meal, a Starbucks beverage, or a fraction of any of the dozens of monthly subscriptions you have and do not use. $7 per day is $210 per month. Over 12 months, that is $2,520. Deployed into a Roth IRA, which I will remind you shields all growth and income from taxation permanently, into a diversified position that generates a blended 7 to 9% annual yield. That $2,500 begins generating income on day one.
Small income, approximately $14 a month at the low end. But the architecture is live. The machine is running. The compounding has begun. In year 5, if you maintain the $7 per day deployment and do not touch the distributions, if you reinvest them into additional units, the machine is generating over $2,000 per year in yield alone. That is a second income stream. It is small, but it is structural. It is a component of a system that will scale with every additional dollar you route to it instead of to consumption. The $100,000 earner with the 8% conversion rate does not have this. He has a truck, and the truck does not pay dividends. Begin Architecture Zero this week. Open the Roth IRA if you do not have one. The 2025 contribution limit is $7,000 per year for individuals under 50. Select 1 or 2 income-generating instruments. Execute the first deployment. Do not wait until you understand every variable perfectly, because the market does not pause for comprehension. Your capital has a conversion rate, and right now, while it sits in a checking account earning fractional interest, that conversion rate is clocked out. The moat is drained. Capital, yield, NAV, REIT, covered call. 5 terms, 0 mystery. The arithmetic is the same for you as it is for the person who manages a 9-figure fund. The only difference between you and that person operationally is that they started converting their capital earlier, and they did not spend their deployment budget on depreciating metal objects with leather interiors. I am Dollar Dave. Next week, we build the architecture.